Are you looking to achieve that financial freedom, especially through dividend stock investment? Well, then stay tuned. Hey everyone, welcome back to my channel once again. This is Abhishek right here, bringing you the second episode of our financial freedom journey. I wanted to actually include 3 growth dividend stocks, but in this video I would be including just one, and I will of course make a second video as well to put up more dividend stocks, including those 2 as well. But trust me guys, it will have all the information which you need to start your dividend investing with this particular stock. So without further ado, let's just get started. So guys, we are talking about one of my favorite long-term hold stocks, Brookfield Renewable Partners, trading at NYSE with the ticker symbol BEP, which is currently at $63.15 at the time of making this video, which is on 27th of November. So the current market cap is at $11.15 billion and the forward dividend yield is at 2.86%. And this would be one of our main topics for today, since we are talking about generating passive income. But before that, let's have a quick look at their business. So a quick overview about the company. Brookfield Renewable Partners operates one of the world's largest publicly traded renewable power platforms. So its portfolio consists of approximately 19,400 megawatts of capacity and 5,318 generating facilities in North America, South America, Europe and Asia. And its investment objective is to deliver long-term annualized total returns of 12 to 15%. Now guys, this number is quite important for us because we would be using this number for our future calculations. And the company is a global leader in hydroelectric power, which comprises approximately 64% of its portfolio. It is also an experienced global owner and operator of an investor in wind, solar, distributed generation and storage facilities. So in other words, we can say that they are the world's largest investors in renewable power and they have the capacity to generate power up to 19,000 megawatts. They also have assets located in North, South America, Europe, India and China. And when we talk about assets, then we mean their business in real estate. So apart from being an investor in renewable sources of energy, they are also one of the largest investors in real estate. They own and operate iconic properties in the world's most dynamic markets. The global portfolio include official, retail, multifamily, logistics, hospitality, self-storage, triple net lease, manufactured housing, and student housing assets on 5 continents. And this protects them from a downside risk because these assets are diversified by sector, geography, and thus reducing the exposure to movement in any single market and minimizing volatility. Now coming back to the renewable power sector part of the business, an important information for all the investors out there is that the majority of their power contracts are long-term contracts and inflation-linked contracts, which actually ensures a stable cash flow for the future of this company. And this in turn means that we as investors would have a strong company to invest in, especially when we are investing in this company from a passive income point of view. Plus, of course, we are investing in a company which won't have any financial problems in the future. So now, considering the fact that decarbonization is a global objective and actually a big global concern, and it's a long way to go, and thus we can be sure that BEP does have quite a good future ahead with all the upcoming projects, because carbon reduction is universal guys, and as you can see right here, current renewable generation is not that significant, and that's why such companies will have quite a lot of business opportunities in the future. Well, and since we are talking about business opportunities, here are some really good corporate targets. Until 2025, Amazon, Walmart and Nike are trying to be 100% renewable. Until 2030, Microsoft and H&M are trying to be carbon free. Until 2040, Amazon and General Motors are trying to be 100% renewable in reducing carbon emissions. And until 2050, Microsoft and Johnson & Johnson wants to be 100% renewable. So these are some targets what can be really huge projects for such companies like BEP. And guys, like you can see here that wind and solar are the cheapest sources of energy, then why not? And actually guys, at times of recession, these companies are making more profit because renewable sources being the cheapest source like we just saw, and therefore renewable generation gets up. Like in this case, renewable generation is up 14%. And therefore the investors out there are in abundance. And as you can see right here that in the next decade, the projected range of investment could reach up to $10 trillion. And since we have touched the topic of investment, well, here's a sneak peek from Biden announcing $2 trillion climate change plan. And this is the message what I'm trying to convey, guys, that
this business would have huge upcoming opportunities backed up by the government itself. So that means that these companies would have long-term government contracts as well with private contracts. And not just this, guys, they themselves have put a 5-year target for increasing their annual equity deployment up to 800 million till $1 billion. And with a growing distribution of 6% at compound annual growth rate over the past 20 years, well, I see that that is easily achievable. And by giving exceptional returns of up to 20% to their customers from saving energy from their solar pipeline project, this is amazing, guys. And with the growing annual addition of renewable sources of power generating capacity has increased in the last 10 years. And there are no signs of slowing down, guys. In fact, as you can see right here, the electricity generation from renewable sources of energy would be just increasing at an exponential rate if compared with electricity which will be generated in future from fuel as source. And guys, when we talk about BEP, well, their business is so well positioned and they are continuing to deliver solid growth through all economic cycles. Because right now, even in such circumstances, they have $3.4 billion of available liquidity. And when I mention in all economic cycles, well, that's true because as you can see right here, even in current global shutdown, they still managed to add $1 billion liquidity. And not just that, guys, if you have a look at their balance sheet, their total asset value currently is at $35 billion in the trailing 12-month period, and it has just increased over the last years. And comparing it with the total liabilities gives us a really good book value, which shows that how well this company is positioned and how stable this company is, and is far away from any case of bankruptcy or any such things. So with all this information, now I hope that you have a better understanding about the company. And we also know now that the company is in a very strong financial position even during the current global situation, and when the situation improves, then the company would show a much greater response to growth. Now guys, coming on to our second main topic of this video, apart from explaining how the company has a really strong financial profile and how the company is aiming at decarbonization and how they have really long-term projects. So the second main topic was that how we would use this particular company for our passive income growth. And before we jump on to some calculations, I would like to show you some key figures. So if you would have invested in BEP 10 years ago, that is in 2010, then you would have got an annual return of 18.6%. Now guys, this number in itself is self-explanatory, or let's say it is quite an amazing return. But just for the sake of better understanding, let's compare it with something big. And so here's your first big comparison. Considering the past 20-year return history, BEP has not just shown a linear growth, but also compared to S&P 500 and S&P 500 ESG index, it has shown some amazing return. So as you can see, BEP with total return of 18%, whereas in case of S&P 500 index, a return of just 6%, and in case of S&P 500 ESG index, return of 11%. And here is your second big comparison. So again, it beats New York Stock Exchange with annual growth return of 18.6% compared to 5.6%. And not just that, guys, compared with NYSE Composite Index, it has shown a massive return of 229% in the past 10 years. So I guess this clearly proves that this company is not just a stable financial company, but also has a good stable appreciation in its stock price. Thus makes it an amazing investment for the future. So now coming on to our topic of passive income and how we will use this particular stock for not only as a growth stock, but also for a stock to generate passive income. And when we talk about passive income in the stock world, then the only thing which comes to our minds is dividend. So now just to explain this quickly, why and how companies pay out dividends, and this statement is right from Investopedia, and it says that under the stable dividend policy, companies consistently pay out dividend each year regardless of earnings fluctuations. The dividend payout amount is typically determined through forecasting long-term earnings and calculating a percentage of earnings to be paid out, which is called payout ratio, which is a percentage of earnings that is to be paid to shareholders in the long term. Or in other words, let's say the companies pay out dividends as a goodwill for its investors from the profits they earn at the end of the day. Now guys, dividends are not a part of mandatory payments for the investors like us, and you might have noticed it quite nicely this year as many companies reduced or completely stopped their dividends because of the current global situation, obviously, and that's why it is very important to choose companies in this case which have a really good history of high payout ratio and financial stability. And that's why that was the first reason why I talked about BEP's financials in the first place. So like we saw also earlier in this video that the dividend yield for BEP is currently at 2.76%. Now like I said guys, while choosing a stock for dividend investing, it is quite important to look at the historical yield rate. And if we see right here, you will notice that the yield rate had been decreasing over the last years. And now you must be thinking, then why the hell I'm talking about this particular stock then, right? And is yield of 3% not that low to invest? Well, then let me explain. Now to answer that why the 3% dividend yield is not bad at all, and I'm taking this example from Investopedia, which is taking an example of Corpus Entertainment, which is the top dividend yielding company with a dividend yield of 26.9%. Now I know being an investor, this percentage is really attractive, but just let's go on. It has a 10-year annualized total return of minus 1.8% guys. So the return on your investment is minus 1.8% and a 3-year annualized total return of minus 18.5%. And if you remember, for BEP, the annual return for 10 years was plus 18.6%. So while it has the best, so-called best dividend yield, its total return is not impressive at all. So what we should remember that a dividend is a percentage of a business profit, right? So the company is paying out dividends from its profit and paying to its owners in the form of cash, also quoted as its payout ratio, like I explained before. Any money that is paid out in form of dividends is not reinvested back into the business. It's quite clear, yeah, that the company's profit, or at the end of the day, the company has cash left and the company is paying out these dividends from this cash which is left. So it simply means that the company is not using this cash back into the business, which in turn they are paying out to its investors in the form of dividends. Now it is good for us, but being a sensible investor, you should think that are you investing in the company just for dividends or are you investing into the business? So this is really important, and you should be surprised actually if the company is paying out 30% or 20% dividend yield, because that means that the company is actually not using the money from the profits back into the business to grow its own business. So as an investor, it is a red signal. Anyway, so it may be a sign that the management prefers not to reinvest in the company given the lack of upside. So the company is lacking an upside potential to grow, and therefore the dividend payout ratio, which measures the percentage of the profits of a company pays out to the shareholders, is a key metric to watch, because it is a sign that dividend payer still has the flexibility to reinvest and grow its business. So that's what I wanted to explain, guys, that whenever you see a low dividend yield rate, it's not bad. It's not bad at all. Look into the business, look into the profitability, look into the cash flow. And then if you see that the company has enough cash to pay out dividends, that means the company is first of all growing, yes, and then it has enough cash to pay out dividends. And this is what a good business is, in simple words. So now to explain you the answer of the second question, that if the dividend yield percentage is decreasing, then why we would still as an investor want to invest in this particular stock? Well, I guess this particular animation is self-explanatory, but let me explain you with a simple example with some numbers. So let's say we have a stock which has a price of $30 and a dividend yield per year of 10%. Now 10% is too high, but just for the sake of simplicity, I'm taking 10%. So that means the dividend which we get annually is $3, and this is simply 10% of $30. Now let's imagine that the company was doing pretty good over the years and the company's stock price is of course rising. There is an appreciation in the stock price because of the company's good performance. Then the company says, okay, the dividend yield percentage would be 5%. Now you must be thinking that the dividend yield has decreased. Yes, but guys, Remember that the dividend which we get annually is 5% of $60, which is still $3. So that is why I'm saying that this percentage is not that important. So we have to check the sum which we are getting as dividends. So I guess now it makes sense, right? So if the yield percentage is going down, then it is not that of an alarming situation, because if the stock price is rising, then we are getting a good yield at the end of the day. And that's what matters. And actually, guys, to be honest, you should be always looking at the stock performance and not the yield. Yes, it is quite important to look at the yield as well, because if you're ultimately investing in a business because of the yield, which actually should not be the sole purpose, you should be investing into the business and not into dividends. It should be based on your due diligence over the complete business. So you are actually buying the business, not dividends. Okay, so you should not be concentrating only on dividends, please remember that, and should not be attracted into these high yield rates from many companies which I have seen in the past few months, and they have ultimately like really put their dividend yields to zero. So anyways, this is the main purpose of this information, that you should be looking at the performance of the company, and the stock price and the percentage is not that important. So the sum is important, what you are getting at the end of the day. So in just simple words, in summary, worry about the business, not about the percentage yield on the dividends. That's it. Okay guys, now to wrap up this video quite quickly before it gets too long, and this is when I said in the beginning of this video that the video will be quite short, but anyways, so this is a dividend calculator which I am referring to, and I have put all the numbers according to the data available for the Brookfield Partners. So the investment type is individual stock. We are just putting for the individual stock, not for the complete portfolio. Yes, it is a taxable account, and our distribution frequency will be monthly. Now DRIP is quite important, because DRIP means dividend reinvestment plan, and this should be yes, because this simply means that you are reinvesting your dividends, what you get at the end of the quarter or yearly or monthly, depending upon the company how they distribute their dividends, and this creates this snowball effect. That means you are putting your dividend back into your investment, and this acts as a compound interest formula. Okay, so the number of shares we are choosing here is 1. The current price of BEP is $63, and the annual contribution, guys, is just $120. And I am being here really conservative, so I'm expecting that even students might be seeing this, watching this video, and so that this is for everyone can actually start this investment. Yeah, this is like a safe investment. I have already showed you all the scenarios of the business. Anyways, you should still be doing your own due diligence, but anyways, so I'm taking here a really conservative approach. So I'm just expecting that you at least have $10 per month saved to invest into this stock. So the annual contribution is just $120. Now the dividend tax rate in Germany is 25%, so 25% on your capital investments, and the annual dividend yield currently is at 2.86%. Now I explained this already, that you should not be bothering about the percentage. It is important, but it is not the most important factor to be considered. Okay, now expected annual dividend increase percentage, I have taken here 0.5%, which is again a really conservative percentage, dividend percentage increase, because so as you can see right here that during past 12 months they have already achieved a growth rate of 1.2%. And why I think that this dividend yield rate won't slow down, because they are already predicting an annual distribution increase of 5 to 9% from organic cash flow growth and project development. And the company is already anticipating to grow its cash flow at an 11% to 16% annual rate until 2025, and which should enable the company to grow its 3.6% yielding dividend at a 5% to 9% annual rate. And with such big upcoming projects, like for example, recently they signed up an agreement with JP Morgan, and it's a 5-year agreement to supply electricity to more than 500 of its offices and branches in New York State. So guys, these are some of the reasons why I'm definitely not worried about the dividend payout from this company. So I guess this explains that this is a really conservative approach. So anyways, moving on. So expected annual share price appreciation percentage per year is 15%. And this data I'm taking from right here. So it is from the BEP stock history, and it says that annualized total returns of 12 to 15% has been there, and that's why I'm taking 15%. And lastly, the time of investment is 15 years. And to be honest, 15 years is also not a good amount of time. You should be putting here 20 years or 30 years, because this actually is kind of a retirement plan and you would be working for at least 20 to 30 years, right? So that's why I would say put here for 20 to 30 years. But like I said, here I'm taking a really conservative approach to show you the power of dividend investment with such growth stocks. So I have taken just 0.5 expected annual dividend increase. I'm taking just $10 annual contribution, and the years I'm taking just 15 years. So still we will see that how this is still a good investment and can be really effective. So just after pressing calculate dividends, here are your three charts explaining portfolio balance. So after 15 years, your portfolio would be worth $7,573. Your dividend income per year would be around $194, and your yield would be 12.7%, which is still higher if you saw earlier in this video than S&P 500 and NYSE. So as you can see right here that at the beginning we just started with just one share, and as the years are passing by with your annual contribution of $120 per year, the number of shares owned are also increasing obviously, and the annual dividend is also increasing. And after DRIP especially, that means dividend reinvesting, your dividend amount is increasing drastically. This is just compound interest, magic of compound interest. And year-end shares owned are increasing as well, and then the new balance is getting the effect of your compound interest, and thus you are having a really good amount at the end of your investment plan. So I hope with this video it's quite clear, guys, that now you know that how and where you should be putting your money for long-term investments, and you be in control of your own money and controlling your own investment plans and investment strategies and letting the money work for you.
So that's it, guys. That's all for today. I hope that you will start your journey through dividend investment. Yes, this is a really slow process, but guys, you need to start an investment and you have to make small baby steps, because trust me, it's never too late. And this is for everyone out there who can start with a small investment every month. That's it. That's all what you have to do. So start saving, start investing, and you will achieve finally someday your financial freedom. So I will see you in the next one, guys. Till then, stay safe, stay healthy, and ciao.